Powell oversaw the printing of the largest amount of money in the shortest period of time in the history of our republic. Wow.
Right?
Then you got our famous Janet Yellen.
Oh,
The party line, inflation is transitory.
unbelievable. She is just, I call her Mrs. Magoo. Your generation won't know who that is, but there was a great comic when I was a kid called Mr. Magoo, and he was a blind guy who wandered around creating chaos. You know, I named the book The Big Print. It's funny, I should have called it The Bigger Print or The Biggest Print.
the biggest print so far.
The coming biggest print, because we've actually had two big prints. We had one in 2008, and then we had another in 2020. And of course, in the book, I lay out the case for why I believe we've got another one coming.
Welcome back to another episode of Cypherpunked. I'm here with my friend Larry Lepard to record episode 5 of our series on his book, The Big Print. Welcome back, Larry.
Nice to be with you, Matty.
Today we're going to talk about a two-tier justice system. Socialism for the rich, capitalism for the poor.
Yep.
1971 to present, chapter 12 of your book, Financialization, Bailouts, Free Money. Can you explain what you mean by this system, this two-tiered system?
Sure. I mean, it started subtly and slowly, but over time, what's come to happen is that the government has started deciding who wins and who loses, and has started bailing out certain institutions. And you know, it goes all the way back into the early 70s. The first time the government bailed out a private company was Lockheed failed, and I guess they believed that from a defense point of view, it was strategically important, and so the government stepped in and bailed them out. And you know, that led to other bailouts. The Continental Illinois Bank failed in 1983. I was actually working there when it failed. It was kind of interesting to watch. And one of my friends called up and said, "Hey, you know what? No one's buying our bonds anymore." I was like, "Well, that's not good, right?" And he said, "No, that's not good at all." And it failed, and the government took it over. The Penn Squared Bank failed. You know, Penn Central Railroad failed. And over time, what we saw was just kind of a continuing lobbying of certain businesses to the government that, you know, they had done bad things, they had misallocated capital, they had made mistakes, and they went to the government and made an argument that they were systematically important, and therefore the government should bail them out. And they did. The government did. And that trend started slowly, but it only grew, and as we'll see, it grew massively over time in events, such that, you know, we had you know, bailouts in the 80s, and then the bailout of the S&Ls in the 90s, and then of course the bailout of LTCM in 1998. And I'm skipping over, you know, a number of smaller events, but and then of course the big one was the 2008 bailout when the GFC occurred, and you know the government just massively changed its monetary policy, and the Fed Reserve behaved in a way that had never been seen before in order to prevent the financial system from collapsing. And what this does, I mean, at a big picture, this is the moral hazard you've spoken about earlier.
Yeah, we're going to talk about that in a second.
And what this does is it basically, you know, it's a socialism for the rich and capitalism for the rest of us. I mean, you know, when Matty gets in trouble financially, the government's not going to bail you out. When Larry gets in trouble, same story.
It's even worse, Larry. When I am having issues, the banks or the government leans on the banks to close my bank accounts.
Well, that's right. Because
I'm in an unfavored industry.
You're in the crypto industry. That's what happened. Yes, you're right. It is even worse. And so the point.
I'd be fine if they just left me alone to do capitalism, but no, it's
they want to do that. They want to make it hard for you to do capitalism. That's right.
The quote that I always get from these guys is, "You're in an what industry? You're in a disprove or I can't remember what they all. Every bank said the same thing. They said you are in an unapproved or some kind of. You're in an unapproved industry. It was like I heard the same line from every bank. It was like, what? Where is this coming from? You guys aren't coming up with this shit. You know?
Yeah. Somebody told you that. So yes, the answer is that that basically. Over time, the role of government has evolved, and there are certain protected industries, banking being the biggest one, that the government has backstopped. And the government, when I say the government, I'm really lumping the federal government in with the Federal Reserve, because the Federal Reserve is an interesting hybrid, right? It's a private entity owned by the banks, but it was created by Congress. The members of the Federal Reserve Board are appointed by the president and approved by Congress. And it sits in kind of an interesting spot where it's part private, part public. But for all intents and purposes, I actually call the Federal Reserve part of the government, because it really is controlled by the government.
Was that the Federal? Did you read recently? Was that the Federal Reserve that was taxpayers were going to foot a $2.5 billion Palace of Versailles that we're building for them? Is that
yes. And Luke Groman had a great tweet about that. How it's kind of an indicator when many companies have built a big headquarters, building to celebrate their success. Mm-hmm. It often indicates that they're near the end of their useful lifespan.
Yeah,
and $2.5 billion to enhance the Federal Reserve building in Washington, D.C.
Where do they get off on this shit?
As if they need it.
I mean it's unbelievable.
It's a large building, and they have 40,000 employees, it's stunning to me what our government wastes money on, but they do.
Crazy.
Yeah.
I'm going to read a excerpt from Jens Parson here that kind of will highlight the chapters we're going to go down here. We come now to the single most important law of inflation, the law of exponential inflation. We may also think of it as the law of geometric progression. Every inflation must compound itself at a geometrically increasing rate in order to continue to have the same beneficial effects as in the beginning. It means, in practical effect, that every inflation, once begun, must become continuously worse. And you've got you wrote after that, when I love this analogy because it's my favorite analogy. This process mirrors addiction. Like an alcoholic treating hangovers with more drinking, each monetary crisis demands increasingly larger intervention. The whole COVID thing is a prime example of this. I'm pretty young, so I don't remember. I was a kid when 2008 and all this stuff was happening, really. Like I had no clue what was going on. But COVID, I mean, you felt it, right? Everyone got those stimulus checks. It's like being on drugs, everybody, you get that high, everybody's happy. And then, here we are later dealing with the consequenges of that, right?
Suddenly your groceries double in cost.
Exactly, yeah. So your rent's up 50%, your groceries double in cost, and oh shit, my wages have not gone up yet to compensate for that. And, really, it really sucks for many people. But I think it's just a great analogy, a way to think about it, that stimulus will have that short-term benefit.
It's like being a drug user as well. I mean, and the problem is, stopping inflation is a form of going cold turkey. And anyone who has a substance abuse problem, they know that that's a very unpleasant process.
Yeah. Can you real quickly just talk about this S&L crisis? I didn't really know anything about that, but you said these were the good old days of financial accountability.
Yeah. So some of the laws changed, and again, the financial industry pushed for this, and they allowed S&Ls to pay higher rates of interest on deposits so they could accumulate deposits, and then the S&Ls got very aggressive about lending into industries and buying things that, S&Ls were originally designed to just help people buy homes, but they got to the point where they were doing much more than that. Mm-hmm. And they got highly leveraged, and they were pretty aggressive about it. And, we had a financial crisis where a lot of S&Ls failed. Over, I think, 900 S&Ls went bankrupt in the kind of the late 80s to early 90 time frame. Some of them rather spectacularly and famously, with, Michael Milken backing them, and the Keating Five and Charles Keating's Savings and Loan, which was a very aggressive S&L, took on a lot of junk bonds, et cetera. And basically, a lot of what they did was not kosher. It wasn't legal. And there was a great law professor out of St. Louis, a guy named William Black, who became kind of the czar of S&L cleanup. And he prosecuted a lot of the people who had kind of broken the rules in terms of taking on leverage and taking on risky loans they weren't supposed to be doing. And there were people who actually went to jail for financial misbehavior in the S&Ls. Mm-hmm. And then, of course, the government had to spend a lot of money to bail out the failing S&Ls because they didn't want to have the depositors lose money. I mean, we've got, the FDIC, and, the general theme post-depression is that the government doesn't want to see banks fail, and I'm not really sure there's been a place in the United States where a depositor has taken a loss. They say the insurance is only up to $250,000 per account. But I think as a practical matter, there really haven't been any bank deposit losses because the government in some way always figures out how to step in.
Yeah. They've got all these interesting little methods they use.
Yeah, and they did it with Silicon Valley Bank.
Yeah, recently we saw that. We'll talk about that a little bit later. But so here you say the average citizen, if they save their money, can only receive a safe return of 4 to 6% in today's environment. But if they need to use credit cards to borrow money, they pay almost 25%.
That's the average rate today, which is just outrageous.
Yeah, it's insane.
It's usury.
So you mentioned this concept of usury.
It's like the mob.
Yeah, usury is defined as the charging of interest on loans over and above what is considered a fair rate.
Right.
Interesting. I know that's
pre the usury law,
religious thing.
Pre the changing of these laws. I think the usury caps were kind of in the 10 to 12% range. So, and what some credit card companies would say, well, we can't loan to risky credits unless you give us these interest rates, and free market we want to have. My view would be fine. Then keep the usury laws in place and don't provide loans to people who aren't creditworthy. Because I think what they're doing is it acts like a drug, and people really get themselves into credit trouble as a result. I mean, you're getting these credit card offers in the mail all the time, and they're so many stories of people who, they take out new credit cards to pay the old ones, right?
Yeah.
And they just dig a deeper and deeper hole.
The only, the saving grace there is that they're allowed to default.
So that's right.
That's right. Obviously that occurs a lot, there's a lot of that.
Right.
When, and again, it's kind of like you're stabbing yourself in the back in a way when you charge these 25% rates, because it becomes so repressive financially that you probably do have a lot more people actually defaulting than if you would just.
Maybe.
So yeah. I'm sure there's some number there that if they actually really looked at it and was like, instead of 25%, if we took 13%, maybe less people would default over time.
Yeah.
And there's probably something to be said there. But just thought was interesting. Here you talk a little bit about the Glass-Steagall Act. Can you explain that? I guess that's what the Securities and Banking Acts of 1933 and 34 that established the SEC.
Right. So the Great Depression, there was a lot of things that were done in the Great Depression that were, when the stock market bubble burst, and there was a lot of misbehavior, so to speak, in that bubble. And the Pecora Commission rooted that out, and they created a couple of new acts that established that what the banks could and couldn't do. And one very smart thing they did was they said, look, the banks who are taking deposits and offering checking accounts, and making commercial loans, they are different than the banks that are underwriting stocks and securities. They're two different functions. And the first one is backed by the Federal Reserve with a backstop, right? So it's almost like a public utility. We've said if they do something that hurts their customers, we'll backstop them. And that's the right role of government. The government shouldn't be in the business of backstopping the stock market. And so what we need to do is we need to create investment banks who handle stocks and stock market activities, and we need to create commercial banks who the Federal Reserve will backstop. And those two need to be separate. And that was the original, that was Glass-Steagall law was what said that, okay? Of course, the problem is that what happened is as time went by and we approached the 90s and 80s and 90s, there were a lot of aggressive commercial banks. The investment banking business is more profitable in general than the commercial banking business. There were a lot of aggressive commercial banks that realized, you know what, let's get in on that profitable trade. We need to break down these barriers.
Yeah.
And so they did. Sandy Weill actually kind of forced through, and a bunch of other, congressmen and so forth, through a bill called Gramm-Leach Bliley. They eliminated Glass-Steagall. And what that did, they also took down the leverage ratio requirements. And all of these things, this occurred in 2000. And it didn't come back to bite them in the ass until 2008.
Yeah.
But all of these things led to more financialization, more leverage, more aggressive behavior. And again, as you point out, it was all moral hazard. And why did they do it? Because they knew that if something went wrong, they would get bailed out.
So I was reading that, what they would do to get around it kind of was like, you kind of have Bank of America and Merrill Lynch, but they're in the same building. You know what I mean?
Right.
They're all going to lunch together, and it's
exactly. No, it was very incestuous even before the law was overturned.
Yeah. Tell me about the golden age. So this is apparently the golden age for fiat currency. The Soviet Union collapsed in 89 to 1990, paid this idea of a peace dividend.
Well, yeah. I mean, there was a time. So inflation, in 1980, after Volcker had taken rates to 20%, and inflation had printed as high as 14%, we actually entered kind of a deflationary period where interest, the rate of interest came down and deflation, productivity took place. The PC was introduced in the early 80s. And so we saw, more computers, more technology. A lot of good things happened that led to a decrease in the rate of inflation. And so inflation trended down from that 14% high to I think in the 80s, it was probably averaging in the 6-7 range. And then by the 90s, it was even lower. And so It appeared, though, as though we had kind of whipped inflation, even though, bank loans and money supply were growing. We were in a deflationary period. And then, of course, China entered the world in 2000 with the World Trade Organization. And suddenly we had 1 billion people working for very low wages. And so that, in turn, helped things get cheaper. And then, of course, more recently we had, we found a lot of shale oil in the United States, and that kept the price of oil lower. So we've had this beautiful deflationary trend as a result of technology, productivity, and we came off of inflationary high in 1980. So for 40 years, we've experienced deflation. I believe that changed in March of 2020 with the COVID example, but there was a golden age period there, and gold at that time. I mean, in 1980, gold was priced at $800 an ounce at its peak. In 2000, gold was priced at $250 an ounce. Now, compared to the money supply, that was the cheapest gold has ever been in its history. But the reason is because people were seeing deflation, not inflation, and people didn't think they needed gold.
Yeah. Oh, it makes a lot of sense.
It made a lot of sense.
Makes a lot of sense.
Yeah.
Let's talk a little bit more about Alan Greenspan. You said that he's your buddy.
Yeah.
He subtly but powerfully transformed the Fed's role from its historical mandate of providing price and unemployment stability to prioritizing asset prices, recognizing that asset prices, principally the stock market, played an outsized role in consumer confidence and economic activity. The Greenspan Fed began treating stock market performance as a new, important metric to manage.
Yeah. So Greenspan came in 87, and there was a crash right after he came in. And everyone thought it would be really bad. We were going to go into a serious downturn. And what he did was he printed a ton of money. He took the interest rates down, and he made it very clear that he was not going to preside over serious financial stress, and that if the economy would hit a bump, he would loosen monetary conditions. He said this many times, and it came to kind of be accepted, and ultimately the market trusted him when it's what he created, what I call and what many called the Greenspan put. So that if financial asset price, as you read, if financial asset prices went down, he realized that was not good. People wouldn't feel as confident. People wouldn't buy, and therefore, so he basically made the stock market become one of his metrics.
Yeah.
And if the stock market wasn't going up, then monetary conditions might be too tight. And so he kept monetary conditions quite loose throughout most of his career.
We're hearing a lot about this today with all the tariffs and, who's going to blink? Is it going to be, the Trump administration, or is it going to be, Jerome Powell at the Fed? Is this the idea of kind of like a Fed put, like if the stock price?
Very much so.
Yeah.
Very much so. I mean, the Fed, I think the Fed put has existed for quite some time.
What do you think what Greenspan did? Do you think it had a big part to play in the .com bubble?
Oh, very much so. Yeah, very, very much so. I mean, so there was a time when he was a little concerned about inflation in 1994, and he started subtly raising rates, and the bond market really, really did poorly as a result of that. And it didn't like the fact that money was getting more expensive, and it sold off heavily, and then that echoed through into the stock market, and suddenly the alarm bells went off in his head, and he backed off of that. And it became very clear. I mean, I described the beginning of the Greenspan put in 87. I would say it was fully in place in 95. If you look at his actions and his language about what they were going to do to the money or to the interest rates, he made it very clear that they were not going to let a downturn occur. At the same time, the .com developments were taking place. The internet really started to become commercial in 95 or 6. You had Netscape go public. You had Netcom go public. I was involved there. And there was a lot of growth in this whole area. And, Cisco Systems was selling routers like crazy. Internet was a huge technological improvement. And so, you had a bubble form around that. And he didn't in any way tighten money at all. He just let the bubble run. And even to the point where, in 1998, the bubble had run a ways, and then we saw, Russia, you had contagion in the Asian countries, then you had Russia blow up. And then that caused the long-term capital management to blow up. And this was another perfect example of moral hazard. In fact, in this chapter, we're going to talk about that.
That's exactly right. That's coming next. But I just wanted to...
I'm sorry.
I wanted to remind you about your friends.
I roofed ahead.
You did. No, it's fine. I mean, I want to remind you about your best friends in the whole world.
There's central bankers.
No. The Committee to Save the World.
Oh, yes.
Larry Summers.
Oh, yeah.
These guys.
See, that's the thing that's so painful about these Keynesians and this whole system is the way... I mean, so obviously they were able to go to Time Magazine and say... hey, we just did this really great thing.
We saved the world.
We bailed out long-term capital management. How about you put us on the cover of Time talking about how this financial thing that we did was such a wonderful event? In the same way that Bernanke, after he printed a ton of money, which was a crime, and bailed out the banks in 2008, was able to get the Atlantic to put him on the cover and call him the hero.
Oh, man.
Right? It's painful, but that's what happens. I mean, again, this is part of the propaganda.
Yeah, it's massive propaganda.
That leaves the rest of us thinking, oh my, these people are doing good things for us. I mean, we need them.
This is the massive problem. I mean, like a lot of these media organizations are getting money from the government as well. Like,
of course.
We just see that. We found this out from NPR and PBS and all the, I mean, like all this money is trickling out and it's going it's it's literally moral hazard, which is,
right.
Why don't we unpack that and explain that?
Right.
LTCM.
Yeah, long-term capital management.
Long-term capital management. I mean, Ritzel drew this conclusion, which you said you agree with. Had LTCM been allowed to fail naturally, perhaps a lesson might have been learned. Risk and reward are sides of the same coin. Alas, it was a missed opportunity for the traders and risk managers at major banks and brokers to learn this simple truism. The parallels between what doomed LTCM in 1998 and forced Wall Street to run to Washington for a handout in 2008 are all there, and the significance of these missed opportunities is now readily apparent.
Yep. So LTCM was long-term capital management. It was a bunch of ex-Wall Street guys from Salomon Brothers, John Merriweather and others, who were PhDs and brilliant mathematicians, and they figured that they had a way to arbitrage the bond market and lever it up like crazy and make a ton of money. And of course, what they didn't understand or expect or predict was that occasionally the bond market did funny things. And of course, when those funny things occurred, all their models broke, and they were way underwater and losing a ton of money. And that would have been fine, and if they'd been a small firm, they would have been just allowed to fail. The problem is they were an enormous firm, and what they had done, of course, is like so many of the banks, they'd become too big to fail.
Yeah.
And so if they failed, all the banks were going to fail. So, yeah, I mean, this is the old, if you owe a banker $10,000 and you're in trouble, well, you're in trouble because they're going to foreclose on you if you don't pay. If you owe the bank $100 million and the bank's only worth $100 million, you can't pay, the bank's got a problem. And so, so the central, so these guys had basically put the entire system at risk.
Wow.
Yeah, with their leverage. And the Fed had to step in and all the banks had to step in, and they cut rates and kind of orchestrated a bailout. It didn't directly involve printing money, but it kind of indirectly did. And so, yeah, the message was, lever yourself up, take great risks. If you're winning on those risks, great. If you lose, we'll figure out some way to work it out.
So that is the very definition of moral hazard, where an economic actor is incentivized to take risk because they believe they are insured against bad outcomes.
Exactly. And as Rithold says, the banks took note of that and said, oh, I get it. If things get too big and it's too bad, they'll have to bail us out. And in 2008, that's exactly what happened.
Bernanke, they called him Helicopter Ben.
Yeah.
He wrote his famous Deflation, making sure it doesn't happen here.
Yeah.
Classic.
He's a bad guy.
Bernanke said the quiet part out loud.
Yeah.
We're going to print money, essentially.
Yeah.
You wrote here, if unsound money is a virus, I call Alan Greenspan patient zero. Ben Bernanke is the super spreader. That made me laugh.
Yeah, that's a good line.
Oh, my goodness. Oh. A host of policy changes and economic shifts aided and abetted the trend toward financialization, concentrating wealth in the financial class. So I think that's what we've seen essentially is this elite class really emerge and grow and grow and grow and grow and grow.
Yeah.
And now there's such a contrast that it feels like something's got to give, right?
Yeah.
Trump has tapped into that energy, right?
Right.
Obama kind of tapped into that, and then Trump got a lot of those voters for both of his elections. What they're trying to do with the tariffs, it seems like it's trying to, how can we rectify this? Like, what's a way we can kind of try to fix this wealth inequality gap? It really feels that way.
Yeah. I mean, it's, the 1% owns 92% of the wealth, and it's because of this financialization.
Yeah, no doubt. No doubt. The famous Dick Cheney quote, because I guess I didn't really realize how much Reagan had ramped up defense expenditures.
Yeah. I mean,
it's interesting
in
to see
today's terms, the numbers are small.
Yeah.
Right?
Yeah. But I thought it was interesting that, this was largely credited for how we got the Soviet Union collapse.
Correct.
This idea of Reaganomics. Interesting. And then, but later on, never let a crisis go to waste. Yeah. You got Dick Cheney here saying in 2002, it's like, Paul, Reagan proved that deficits don't matter.
Right.
Classic. So you also mentioned this rule, which I think most people don't know about, which I thought was interesting to maybe just to briefly touch on, is this idea of allowing corporations to buy back their own stock in the open market.
That used to be considered stock manipulation.
Mm-hmm.
And one of the things that it did, and it aided and abetted in the financialization, is that suddenly CEOs had a new metric for getting themselves rich. If they were getting compensated heavily through stock options, and they could buy back their own shares with the corporation's capital and using leverage to do so, that would increase the price of those options, and they would make a lot of money as a result of doing so. The problem is what they left behind was a heavily levered corporation that somebody else would have to deal with when they retired.
Yeah.
And so it was another one of these short-term financialization fixes where they got rich, but somebody else had to pay the price later.
Yeah. Do you think, would you change that if you had the choice?
I would.
Yeah.
I would.
How would you handle that situation?
I would say I don't think corporations should be able to buy back their stock. I really don't. I think it should just be stock is there and that's that.
Yeah.
Because it disincentivizes CEOs to do what's best for all shareholders.
Interesting.
Because they can use leverage. There's the use of leverage. There's a theme that goes throughout the entire book. The use of leverage is a very, very dangerous thing, and it's generally aimed at gaining profit that's not really yours. You know what I mean? And it just causes a lot of problems. And by the way, in a sound money world, where the money is appreciating in value, not depreciating in value, you have less need, or you would not want to use leverage because you have to pay it back in dollars that are worth more, right?
Yeah. I thought you gave this example, and we're seeing so much of this with Doge right now.
Yeah.
But this idea of this senator from Texas, his wife, Dr. Wendy Graham.
Isn't that amazing?
But this is like nothing. This is with Doge.
Small beans.
This is like small beans.
I know.
But like that, this shit can even happen. Just so insane.
Right.
With this whole Enron thing, and the Senator Phil Gramm of Texas, the bill's chief sponsor, his wife, Dr. Wendy Graham, served on Enron's board of directors, receiving between $950,000 and $1.85 million from 1993 to 2001. So you wrote, the wife of a U.S. senator who led the committee to change the laws and thereby enabled massive fraud at Enron, was paid over $1 million by the same company that benefited from the law changes and defrauded investors. Perfect. We're seeing this right now with all these activist judges in Washington, D.C. And if you look at who their wives are and their daughters are, it's like they're on the boards of these NGOs that are getting paid billions of dollars of taxpayer money.
Yeah.
So it's like, but they're ruling on the cases and no, we can't let these deportation happen, or we can't let this happen. And the guy's daughter's like on the board of like an NGO that's getting $2 billion a year from the government, from the taxpayer, to like help illegal immigration or whatever it may be. Right. It's just like such a conflict of interest.
Yep.
It's beyond criminal in my mind. Just crazy. Why did the SEC in 2004 relax these leverage restrictions for the 5 largest investment banks?
I'm not entirely sure, to be honest with you. I didn't dig into the history of that very carefully. My suspicion is that there was lobbying by the banks on their part to do it.
Yeah, it just seems so.
Yeah, no, it's totally irresponsible.
Yeah, so irresponsible.
One possibility, if you think of the timing, 2004. So recall that the dot-com bubble burst in 2000.
Yeah.
Stock market went down 50% between 2000 and 2003. At the time, Greenspan came out and said, hey, tap the equity in your home if you need to. They took interest rates to 1%. As I recall, mortgage rates came down substantially.
Yeah.
And of course, that's what started the housing bubble. So my suspicion is what happened, and I haven't gone deep into the investigation on this. My suspicion is what happened is the banks went to the government and said, hey, if you want to get housing going again, you want to get the economy started again from the dot-com bust, it would really be helpful if we could use more leverage. Right? That's my guess as to what probably happened.
Yeah, it just seems so irresponsible.
It's totally irresponsible. Of course,
12 to 1 is already crazy.
And 4 years later, it blew up on them.
It's like 40 to 1. Yeah,
it totally blew up on them. But again, when you have moral hazard and they have a, heads we win, tails you lose attitude, why not? We'll take on the leverage, make the money.
Mm-hmm. You wrote, the GFC radicalized me for sound money.
Yeah, it did. I'm on a jihad.
Yeah.
I'm a radical jihadist.
Oh my goodness. Fed Reserve Board member Bernanke said there was little risk in lending to the housing market
because
it was regional, and that housing prices declines were regional and had never declined on a nationwide basis. My reaction when I heard this was bullshit. He was not looking back far enough. In the Great Depression, nationwide average house prices peaked in 1929, and by 1932 they had fallen by 67%.
Right. Never had a nationwide housing price decline.
Yeah.
Come on, man.
These guys just cherry pick whatever they want.
Yeah.
Just
come on.
History.
I mean, he was right post World War II.
Yeah.
But he wasn't looking back far enough.
Yeah. Wow. Wild. I actually, the idea of taking home, HELOC, out of your own home,
HELOC, yeah.
It was probably the one time that's probably the one access to cheap money that the average pleb could get.
Absolutely.
So that I'm like,
no, we all did it. I took a small one. I mean, it was. Yeah.
The famous ninja loans. This is classic.
Do you remember this?
I mean, again, I was a kid when all this was happening. So but I just remember hearing about it and I remember hearing growing up, and then, the Democrats have one narrative, the Republicans have another narrative. And I'm trying to navigate these two different realities, what the truth is. But obviously, this is crazy that, they basically issued these credit to anybody, including borrowers with little ability to repay, famously known as ninja, loans with no income, no job, and no assets. Oh man, I mean, you can't even make this up. You
can't.
So some people say that the government enabled, they basically required you to give the banks to give loans to people that were financially not capable of that. Is there any truth to that? Is that?
I don't know. I didn't see so much of that. Maybe there's some truth, but I think it was more just the chasing of profits on the part of all the bankers and rating agencies lied about the quality of the loans and so forth.
I want to say it's called something called the Community Reinvestment Act or something like that. Does that sound familiar?
Yeah, it does. And maybe that was a piece of it. I didn't actually mention that in the book, and I didn't research that heavily, but it's entirely possible that there was a government push on some of it. Yeah. Yeah,
that was, they were trying to get everybody, people that weren't qualified in on it, so they incentivized that in a way.
That may have been true. That's something I should have researched and looked at. I missed that.
I mean, I'm no expert on this, but
no, but it's. I think I have a vague memory of that same idea. Yeah.
The funny thing of this is how they did this financial engineering with the CDOs and the they diversified
the movie
portfolios.
The Big Short was such. Thank God that book got written, and thank God that movie got made. I mean, Michael Lewis really deserves kudos for that.
No doubt. It was crazy. I got to throw in the Jim Cramer.
Oh.
We got to get Jim Cramer. We got to put him on blast for a minute. So I guess Bear Stearns was operating at a leverage ratio of 33 to 1 almost. This implied that a 3% change in the value of the loans held by Bear Stearns would wipe them out. It did, despite CNBC's Jim Cramer reassuring investors that Bear was safe just a week prior. Yeah. The firm collapsed, prompting a dramatic intervention by the Fed to broker a deal with JP Morgan.
Yeah, and the Fed gave JP Morgan $20 billion or some big number to help them do it because the hole was too deep.
Yeah, to sweeten the deal, we got to throw in a lot of taxpayer money there.
Right.
But, I mean, Jim Cramer, how does this guy keep going out on TV? He's just become a meme. I mean,
he's paid to lie. I mean, what he does.
Yeah, it's crazy. Let's talk about TARP a little bit.
Sure.
And just maybe explain what that is for our listeners.
Yeah, TARP stands for Troubled Asset Relief Program. So in the fall of 2008, that's when the global financial crisis really broke out. And the book details kind of each event as it came along. And basically what happened is, the Lehman Brothers failed. And it was very clear that everyone was over-levered and the entire New York banking system was going to collapse. And so the Treasury Secretary at the time, Hank Paulson, went to Nancy Pelosi, who was the Speaker of the House, and said, look, we're literally looking at the entire financial system melting down, and the ATMs will not work. if the government isn't willing to write a big check to assure all the creditors of these banks and financial institutions that they will be made whole. Because what will happen is somebody will demand their money back, and then that'll cascade through the whole system, and you'll have, we're going to have 25 banks fail. And as you said, the ATMs, he was right. I mean, he's not lying about any of this. This was all true because of the leverage in the system. And so Pelosi and the others at the House, they took it up and they ran it for a vote. And it's very interesting. And they, the populace was polled, should we bail out the banks? and the polls came back like, 80 to 90% no.
No. Yeah.
Absolutely not. I mean, these guys screwed it up, let them fail.
Yeah.
Right. And so the first vote in the House, and there was a big campaign to get, call your congressman, tell them we hate this. Right.
Yeah.
And so the first time it came up for a vote, it failed. It did not go through. Well, then the stock market went down very sharply in the next week. And they reiterated the demand and said, look, guys, you don't get it. If we do not pass this, the ATMs will not work.
Wow.
And so the Congress people passed it.
Wow.
Yeah.
Do you think that's true?
That the ATMs wouldn't work? I think it's possible. Yeah. I do think it was true. They were virtually on the edge of collapse. Now, I think they could have dealt with it in a much better way. And I actually outlined this in the book. And let me just quickly summarize what my proposed solution is. Okay, fine. We don't want the banks to fail. We don't want depositors to be hurt. We don't want innocent people to be hurt. But you guys who put us in this situation, this is all wrong. You knew it was wrong. You were involved in massive moral hazard. And here's what we're going to do. We're going to bail you out, but our condition is you are all going to resign. All of your board of directors are resign. All your senior executives are going to resign. We are going to recruit bankers from medium-sized banks in the Midwest and the South and the West come in and run these things as public utilities for a while until we get them cleaned up. But we're going to strip you of the last 5 years of your gains, and you are not going to continue to run these banks. And because what happened is when they did get bailed out, when the $700 trillion came through, in the next year, and in that very year, they paid $20 billion worth of bonuses.
I mean, you can't make this shit up, man.
Right?
It is unbelievable.
You can't make it up.
You just cannot make this up.
Yeah.
I mean,
so these guys ran the financial system into the ground, and they had failed, and yet they were rewarded for it. This is socialism for the rich. This is crony capitalism. They were rewarded for it, and they got to, one, live to play another day and make more money, but two, they were even able to use some of the money they received to pay bonuses.
Yeah.
And by the way, that $700 billion became inflation. That's why gasoline and grocery prices went up. So somebody said, there's no free lunch, right? The $700 billion, I mean, it was printed out of nothing, but it increased the money supply, and we all paid for it.
Yeah. Socialized losses to, the tax-paying American and the little guy, right?
Right. The little guy paid their fair share of it.
Yeah. This idea of a cleansing failure, obviously we didn't really allow this to take place.
No.
But it's an interesting concept because you could argue that the Great Depression occurred because the cleansing failure was allowed to take place.
Correct.
So I kind of see
both sides of it. I get it.
Yeah.
I get it. But, look, the real solution, and this is what von Mises said, is to never let the credit bubble to
I agree with you.
build to occur to begin with. I mean, the fact is a bursting credit bubble.
There has to be an earlier off-ramp, which is what we had.
Somebody's going to get hurt.
Yeah.
I mean, there's no way to avoid that. Somebody's going to get hurt. But what I'm trying to suggest, and what I suggested with my proposal, is that the people who did it should have suffered consequences for having done it. And they did not.
There's no accountability.
There was no accountability.
Which pervades, American culture these days. I mean, you see it in everything. It's, there's just no sense of accountability in so many.
Correct.
It's pervaded American culture. You wrote here, the fact that the Fed can create, or actually this is what Ron Paul said, the fact that the Fed can create trillions of dollars and distribute them to its cronies without congressional oversight should shock us all. I thought I was immune to being shocked by what our government does, but the actions of the Fed in 2008 and 2009 went beyond the pale.
Correct. There's some other good quotes about the one about the teenager. Do you have that one yet? We'll get to that.
We'll probably get to it. Yeah. This takes us to this FASB, Financial Accounting Standards Board. They made a crucial modification to Rule 157.
Yeah.
I guess the amendment allows banks to classify certain assets as held to maturity, enabling them to value these assets based on theoretical models rather than market prices, or as industry critics equipped, moving from market to market to mark to myth.
Yeah.
Boy, did this blow up for was it Silicon Valley?
Exactly.
I mean, this is like,
and then that came around to bite him in the ass
bit him right in the ass.
bunch of years later. Yeah. I mean, yeah. So they not only took rates to zero, they not only gave huge subsidies with TARP, they not only printed a ton of money in QE, but that wasn't enough. They still weren't recovering. The banks were still insolvent, and so they said, okay, we're going to rewrite the accounting rules, and you can take these things that aren't worth $100, and you can say they're worth $100 in a longer time frame, held to maturity. So they it was voodoo accounting.
Voodoo accounting. I got some more voodoo for you. Let's talk a little bit about ZIRP, and then my favorite, quantitative easing.
Oh yeah, well,
there's 40,000 federal employees that are employed by the Federal Reserve, and they came up with this term called quantitative easing.
Yeah, they might have well just said printing money, because that's a much more descriptive and accurate, tale for what they did. So when this whole thing burst, Bernanke got to put into effect all the things he had written about in his helicopter speech. He immediately took interest rates to zero, and he immediately started buying assets and troubled assets. And he even encouraged others to buy troubled assets. I think we may have already spoken about the Real Housewives who bought some troubled assets. But the point is that they through the money supply, through the money mechanism, they printed money, they mouse click money, and the government started buying these assets and putting them on its balance sheet in what's called quantitative easing, which really is nothing more than buying troubled assets from the banks and giving the banks new money to replace the troubled assets. And then, of course, the banks can take the new money and lend it out and grow the money supply in a fractional reserve manner. So. And this was on a size and scale that had never, ever been done or tried before. I mean, the Federal Reserve balance sheet pre the financial crisis was about $800 to $900 billion. And over the course of the next 3 or 4 years, Bernanke took the balance sheet up to, I think, the high threes, low fours. I don't have the exact number, but it was a big growth. And of course, this ballooned the money supply and then ultimately led to inflation as well, although inflation was more contained than in the past because they made some other rules changes that kept the inflation out of financial or services prices and goods prices and led to more inflation in financial assets, which is the everything bubble that we now live in.
I think you said way later in the book, you said that like this is what you actually missed when you thought all this.
I did.
Yeah,
made a mistake.
Yeah. Because it didn't make its way into the thing. The banks just kind of sat on it.
The banks sat on it, and used it for investment purposes.
I mean, they play all these little games and do all this stuff. It's just very wild. It's insane. But I think something very important to talk about here, and many Bitcoiners know this, and Austrian economists who believe in that like really understand this concept. But the average listener really might not get it. And it's this idea of this effect called the Cantillon effect.
Yes,
Richard Cantillon. Who was an Irish-French economist, talked about this in the 1700s, right? He preceded even Adam Smith. But he was the first to explain that when new money came into a system, those who got it first benefited at the expense of all the others who only received it later. The logic is simple. New money coming into a system is inflation. Those who get the new money first are able to buy goods at the pre-inflation prices. This additional demand for goods and services then leads to price inflation that everyone who did not receive the original new money is forced to bear. And I think this is so important. And you right here, you say, if you want to know why financial operators are insanely rich, you need to look no further than this explanation. Yeah. And I think, this is so important. And it's such a important factor in why that wealth inequality gap just continues to grow.
Exactly. I mean, it's really, and it's sophisticated and it's subtle.
Yeah.
But if you were a hedge fund guy or a private equity guy or anybody who could access that cheap money, you could, and I said in there, allow you and me to borrow money at 0% and invest it in assets that yield 7 to 15%.
It's a no-brainer.
We'll get rich too.
Yeah.
I mean, this is not rocket science.
Yeah.
Please lend me some 0% money so I can invest it in something that gives me 10%.
Yeah.
So I'm earning that 10% basically for free. And then I'll lever it up and I'll do it over and over and over again. And this is how these people have gotten insanely rich.
We have a special term for these people. We call them cantillionaires.
Right. Cantillon was the guy, and we've turned it into a cantillionaire.
All right. Here, let's see. ZIRP, the dividend recapitalization. What does that mean?
Yeah. So I talk about here private equity a little bit. So this 0% interest rate policy really put wind into the sails of hedge funds and private equity operators. And what these guys did and this is why so many of them are so insanely rich, is they went out and they borrowed this money very cheaply and they bought businesses. Sometimes they'd lever the business up, and then they would pay out a big dividend to themselves. And so rather than wait until the business became more valuable, which is what they're supposed to be doing, they got the dividend that they used to pay as a result of the leverage. And this goes back to, remember how I was talking about the corporate CEOs who would lever a business up to jive the stock price up and then leave somebody else to handle the debt? They would have something called a dividend recapitalization. So they would recoup their investment and a big profit on the business, but the business was carrying a ton of debt.
Yeah.
And then the business would ultimately run into trouble and might go bankrupt. But they didn't care because they'd already paid it out. They'd already made their money. So it was really nothing more than stealing the value of the business from the shareholders and the employees and the pension holders. And so Toys R Us, and there's a whole list in the book of companies that they did this with. And everybody except that private equity operator got hurt. The employees of the company got hurt when it went bankrupt. The people who hold pensions from that company got hurt when it went bankrupt. The investors, the equity investors in the company got hurt when it went bankrupt. All of those people got hurt, but the private equity person did incredibly well, and they were able to do that because of the free money that the Fed had given them.
Wow. Excerpting President Grover Cleveland's warning to Congress in 1893. We're talking Judy Shelton put together some analysis here. Her analysis underscores how deeply the previous generation understood the perils of monetary manipulation, particularly its societal and political repercussions. She got some really interesting quotes here that another famous American president said, Grover Cleveland, their government has no right to injure them by financial experiments opposed to the policy and practice of other civilized states. Nor is it justified in permitting an exaggerated and unreasonable reliance on our national strength and ability to jeopardize the soundness of the people's money. Further, he went on to say, and this is, really breaks a lot of this down. He goes, at times like the present, when the evils of unsound finance threaten us, the speculator may anticipate a harvest gathered from the misfortune of others. The capitalist may protect himself by hoarding or may even find profit in the fluctuation of values. But the wage earner is practically defenseless. He relies for work upon the ventures of confident and contented capital. This failing him, his condition is without alleviation, for he can neither prey on the misfortune of others nor hoard his labor. Grover Cleveland, he really explained here that
he got it.
The most vulnerable bear the brunt of the consequences of all of this, right?
Exactly. He was the 22nd president of the United States. Yeah. This was all pre-Fed. I mean, he was 1837 to 1908, and he understood it. I mean, the financial manipulation that takes place hurts average people. Back to the Constitution, back to the premise that this country was founded on, which is a level playing field for all people. To pursue happiness in their own way, shape, and form, knowing that we're all unequal in talents. This is not a level playing field. This is an unlevel playing field.
I think a couple other interesting points in this chapter. You talk a little bit about Amazon and how they kind of abuse this to become a monopoly. Can you unpack that a little bit?
Yeah, I mean, so ZIRP actually, and don't get me wrong, I respect kind of what Amazon has done.
Of course.
But low interest rates allowed things. I mean, Amazon was always a company in the early days. I looked at investing in it. It was always a company in the early days that was losing money, a lot of money. I mean, and I thought to myself, well, okay, if I sell a dollar bill for 90 cents, I'm going to have a lot of customers come buy the dollar bill.
Yeah.
Because they're making money off me. Amazon was only willing to do that because they knew that their cost of capital was low. And their cost of capital was low because interest rates were low. And so here you have kind of a quintillionaire who used the low interest rate environment to build a monopoly business by driving everybody else out of business because they could price low. And this is what antitrust is designed to prevent. A monopolist will come in and they will sell below their cost for a while until all their competitors go out of business. And then they're able to increase the prices and they have no competition left. So
without mispriced cheap capital, he could have never done this. I was not aware of that. That was an interesting little side note story to learn about.
Yeah.
You talk about Europe, Japan, Scandinavian countries. They actually dipped into negative interest rates.
Yeah.
This concept
It's amazing,
is
isn't
weird
it?
as it sounds, you wrote. Deposit holders actually paid banks to hold their money.
Yeah.
And yet at its peak, there was 18 trillion of negative interest rate debt outstanding. That blows my mind.
Same. I don't know how
Like,
that
how
happened.
can you, like, my understanding is there's these negative bonds where like you give $100 and then like I basically tell you like, okay, I'll give me 95 of those real dollars. Like in nominal terms and real terms, you're losing across the board. Why would anybody
Well,
ever buy that?
I think the central banks set rates at a negative level, and if you're a big institution in one of these European countries and you owned either bonds or anything debt oriented, what was your defense against that? Your only defense against that was to convert that financial security into cash and hold the cash, because the cash isn't going to be discounted,
Yeah.
But if you wanted to, what they basically said is, if you want to deposit your capital here, we're going to give you back, 98 cents on the dollar. So for us to hold your capital, you're not going to get as much back. I mean, it is weird, and it's
very strange.
It's kind of unbelievable that it occurred. But I mean,
Some people, would buy those instruments, though.
Yeah, right. Well, nobody would buy them. I mean, what happened is they already held them, and they didn't have any place else to put them, right? But the point is, I mean, it's I mean, in the United States, I mean, and the Fed officials at the time said, we'll never do that, and that was smart. It's just a stupid thing to do. And the Fed said, I mean, QE got born because when interest rate policy becomes zero,
What else are you going to do?
What else are you going to do? You don't have any tools left. And so, the other tool is you just print the money. But in the case of the Europeans, they tested negative interest rates, which, it's insane.
I thought this is another funny one. Texas Congressman Ron Paul and others warned of how inflationary this action would be, but the Fed chairman assured the country that this would not be a problem. When questioned by Dr. Paul in front of Congress, Bernanke testified that the Fed balance sheet, a proxy for the money supply, which was then 2.2 trillion, would be reduced to under 1 trillion as the crisis passed. Today, the Fed balance sheet stands at 7.2 trillion.
Right.
Bernanke should apologize for lying to the American public. He had no exit strategy, and he knew it. Wild.
Yeah.
This idea of QE infinity, creating a tidal wave of fiat currency. Do you want to explain what QE infinity is?
Yeah, well, as you recall, if you go back to 2008, you look at it, they had QE1, QE2, and then QE3, which some people dubbed QE infinity. When they did QE1 and 2, they actually talked about how much they were going to do. I don't, off the top of my head, I don't have the exact numbers, but like we're going to do $1.2 trillion or something. When they did the third one, they actually didn't even speak about the amount. They just kind of said it's open-ended. And so a lot of wags called it QE infinity because we don't even know how big it's going to be.
Yeah.
And so that's how we got there.
Wow. We've got the taper tantrum, repos, COVID, kind of accelerates here. Obviously, the money printing gets, at the beginning of this chapter, I read that quote by Jens, and it was just like, it gets worse and worse and worse and worse.
Yeah.
So
Silicon Valley Bank,
Yeah.
COVID.
Yeah.
I mean,
So here we're at COVID now after the big financial crisis. Unprecedented levels of monetary and fiscal expansion. The government plays the arsonist, then claims to be the firefighter, expanding its power and control under the pretense of saving us. If you are like me, you wrote, you cannot help but conclude that the Fed doesn't really know what they're doing and they're making it up on the fly. Yeah, I couldn't agree more with you.
isn't that right? I mean, it's just like, yeah. And we know each crisis will get worse. I mean, I think we should point out that it took Bernanke 4 years to print $3 trillion, in several phases of QE. When COVID broke out, we printed $5 trillion in 18 months.
Wow. Yeah.
So faster and more.
2008 playbook, but on steroids.
Exactly.
Wow. Can you explain the concept of quantitative tightening? Because obviously that's something that's supposedly been happening.
Well, so they quantitatively ease by purchasing bonds that are in the market in order to keep interest rates low and to support the bond market. They put those bonds on their balance sheet and they issued new money into the marketplace, which in the form of bank reserves, which then can get lent out and create growth in the money supply. Quantitative tightening is actually just doing the entire thing in reverse. So instead of buying bonds and issuing cash into the market for those bonds, they have bonds on their balance sheet and they let them roll off, or naturally as they mature, or they sell them. They say, we're not going to buy these bonds anymore. We are going to sell these bonds into the marketplace, and the cash you give us, banks or whoever we sell them to, that is going to reduce the money supply. So it's a quantitative tightening event. Keep in mind that the Fed balance sheet and the money supply, while not perfect substitutes for one another, they are very strongly correlated. And so it's just the same process in reverse. We're going to let these bonds mature or sell these bonds, and we are therefore going to have smaller. And it should be disinflationary. It should, and to an extent, it has been. I mean, when they started this QT process with a rate, I mean, in February of 22, after they had the enormous inflation from COVID, Powell said, "Okay, I get it.
They're all blurring together at this point."
I messed it up. I'm going to jack rates really quickly, and we're going to shrink our balance sheet, and that's what they've been doing.
Interesting. I've been looking at the inflation numbers, the trueflation. I think it's truff. They're they're actually like,
and they're lower. Yeah,
they're predicting. They've kind of been leading the government statistics. I guess they have their methodology figured out, so they can predict it in advance, which I find is pretty interesting. They've been pretty damn accurate with it.
They have. Yeah,
they've got us down to 1.35% right now. So it seems like that quantitative tightening maybe is working.
Possibly. I mean, again, the problem with all these inflation numbers is just how cooked they are.
Yeah.
And it's so hard to know inflation in what area. I mean, it's.
Well, you got to realize it's like just because that number is going down, things are still inflating, just not as quickly. They're never going back down to what they were.
No.
Right?
We're not going to write deflation.
Yes,
that's not happening. Yeah. Groceries are not going to get cheap again. They just might not get as expensive as quickly.
Exactly. This idea of a bond, right? A lot of people hear this. They're like, what the heck does this even mean? You have a definition here where you wrote, a bond represents a fixed agreement to pay interest and principal at future dates to the buyer of the bond. The market price or value of the bond fluctuates with market interest rates. Once a bond has been issued, if interest rates go up, the market price of that bond will go down so that the new yield to maturity reflects the new market interest rate. So bond prices trade inversely to interest rates. Right. Higher rates, bond prices down. Lower rates, bond prices up. That's kind of
it's counterintuitive.
It seems really counterintuitive.
It is counterintuitive. A lot of people don't understand bond math unless you're in the financial world. You don't really get it. But I just prefer to talk about our interest rates going up or interest rates going down.
Okay.
But because bonds are a fixed obligation, their price varies inversely because the price, the interest payment's fixed. So the price has to change to make the interest payment equal the market interest rate.
Gotcha.
That's what's going on.
Interesting. You mentioned this period where I think this was like during COVID. The market for U.S. Treasury bonds sold off, and at one point, arguably went no bid.
Yeah.
I guess the U.S. Treasury market is the bedrock of global finance. So what exactly happened there?
Well, so this was March of 2020. And, basically, as you'll all recall, COVID was an enormous shock. Everything shut down overnight very quickly. And the stock market went down 30% in the span of a few weeks. It was really kind of a mass financial panic. And, of course, we were in an everything bubble, and everything has once again grown quite leveraged post-2008. And what you saw happen, I mean, typically what was most unusual about this case is typically when the stock market sells off hard, the bond market catches a real bid because stocks are considered risky and bonds are considered safe, right? And so people say, well, if the economy is going into the tank, I'm going to sell my stocks and buy bonds because at least bonds will pay a good solid rate of interest. Well, in this particular case, that happened for a little while and then it changed and the bonds actually started to sell off as well. And that was really important. And why did that happen? I believe, and most who've examined it also believe, that occurred because people realized that the government was going to have to print money to make the bonds money good, and that was going to be massive inflation. It was going to lead to massive inflation. And so, as I say, the bond market, kind of went no bid. And, these financial shock events, what happens is in a leveraged system, everyone needs to see what they have to make certain margin calls or they have to pay certain debts. Or the value of everything's going down and they panic and they need cash. In a deflation or depression or a crash, cash is king. And so you sell whatever you can. And bonds are highly liquid. And so people were selling bonds too. And they were selling stocks and gold and Bitcoin, all of it. Yeah. It all went down. It's a correlation of one.
Yeah, makes sense. Mario Draghi, I remember hearing this, right. And he's quite a character. He says, "We will do whatever it takes, and believe me, it will be enough."
Exactly.
The money printers are primed.
Yep.
That's I remember hearing that like being
Yeah,
like
2011, the Euro crisis, 2011
barely
to
being
2013. Yeah.
I was like a kid still, and I was like, I will never forget like hearing that. It was like a big deal when he said that.
Yeah,
I'm like, what is he even talking about? I had no clue at the time.
Yeah. He was basically saying, don't worry, we'll print enough money.
Yeah, exactly.
You know how to do that.
Yeah, COVID is an interesting. Now I'm old enough to really understand what's happening and to like see everything that happened and really witness in real time the inflation that occurred. And having studied Austrian economics, it was obvious what was going to happen. And then of course the 40,000 Fed employees and the highly educated cantillionaires, they said, this is just transitory. It's no big deal.
It's all good.
This, that, and the other. It's all good. But witnessing it all kind of happened in real time, right? With the mouse click, all this mouse click money, massive, printing of money.
Well, and the big thing that happened with COVID that I'm sure they will use in the future because people will be hurting very badly is they got very direct about the printing of the money. In the past they'd had SERP, we went to. In the past they'd had QE, which they went to, but they introduced STIMIs and PPP.
Yeah,
those are new.
Yeah.
Right. I mean, as we all know, they literally sent checks out to Americans, money they didn't have, money they just printed. Right. Yeah. And in turn, they literally sent money out to corporations, the PPP, Purchasing Power Protection Program, where they said, okay, if you don't fire anybody, for X amount of time, this loan will be forgiven. And as we know, many businesses that did not need those loans were granted millions and millions of dollars. Yeah.
Total COVID related spending is over $5 trillion.
Right.
It's hard to imagine.
And again, who paid for that? We all paid for it.
Yeah.
Because the money was printed.
Of course.
And that's why groceries are expensive. I mean, it's just, I hate to keep beating
it's like that drug addict.
I hate to keep beating this point home though, because I get so frustrated when I see the Elizabeth Warrens of the world saying it's the greedy corporations that are pushing up prices. No.
Idiotic.
It's bad government policy.
Yeah, terrible. What I'm trying to understand is, and again, I think we might have talked about this previously, maybe on another podcast, but the STIMI checks went directly to people.
Right.
But what I read was that they printed $20,000 per head per person.
Correct.
And they sent out a $1,200 check or however much they sent out. What happened to that other 19,000?
Mostly it's in the PPP.
Mostly it's in the PPP.
Yeah. And so the corporations, and think about those corporations. Some of them were public, some of them were private. But I know, I have friends, I know people who had private corporations that received enormous checks.
Yeah, I know plenty of people. And, I know people that literally, I know so many people were abusing that and doing all sorts of crazy stuff.
Yeah. I mean, you saw, people driving around with Range Rovers and they had a license plate that said PPP on them. I mean, it's kind of like, hey, maybe you want to be not quite so obvious.
Can't even make that up. Make this shit up, man. But it was, if you were politically connected, if you were a cantillionaire, if you have, the legal staff and the accounting staff to like figure all that out and navigate all that,
right?
The average small business doesn't.
Well, yeah, they weren't giving loans to dry cleaners.
Yeah,
they weren't. I mean,
and even if they were, the issue is most dry cleaners, have no clue how to even do it.
Right.
They had no clue how to go through this process and do all this stuff. Right. I mean, it wasn't simple. It was like you had to be a cantillionaire.
No, small businesses were not getting helped.
Yeah.
You had to be a business owner of a medium-sized business,
medium or extremely large business to really take advantage of that. And then some of the numbers that I saw were staggering.
They were staggering. Yeah. And well, I mean. And some of the people who got them, I mean, I think Oprah Winfrey got them. I think Tom Brady got one. I mean, these are people who are very, very rich people, and I mean, I'm sure their response is, well, it was available and everyone else was taking it. Why shouldn't I? But that's part of the problem of the government handing out money.
Yeah. They have no idea how to efficiently allocate
who's going to get it?
Stay out of the way and let people decide what they're going to do.
Right. I mean, I've often argued that, look, I get that COVID was a full stop economy event. I think the solution would have been said, okay, restaurants, trains, airplanes, hotels, you can get PPP loans. Everybody else, tough shit.
Yeah, I would have.
I mean, those businesses were legitimately damaged by the government policy of shutting everything down.
Yeah,
I get that.
I would have much rather, if they're going to do all this. Here you put roughly of the $19,000 spent per taxpayer, the average family saw just $3,500. I would have rather just give everybody the $19,000 and say, "Hey, we're giving you $19,000. These industries are going to get hurt, and they're going to sell some shares of stock. You should, maybe put a little bit to it and support them."
That
was what I was thinking.
That's a good idea too.
It's kind of wild. But I guess the $3.2 trillion of the money printed went to businesses, many of which didn't even need PPP loans. As Lynn Alden writes, she talks about this, that 3/4 of the funds went to the top 20% wealthiest households, and very little went to actually keeping workers in their jobs.
Right.
Wild.
It's a government policy. It's misdesigned.
Yeah.
But again, it was quickly put together.
Of course.
We got to do something.
Yeah.
Right?
You know, if you were a working American, you got enough for a few grocery runs while watching prices soar on everything from milk to gasoline. This wasn't just pandemic assistance. It was the greatest upward transfer of wealth in modern history.
$5 trillion, a lot of money.
Wow. Then the whole transitory thing. Yeah. Sure. Okay. He remained remarkably oblivious, talking about Powell, to the mounting inflation tsunami. Powell oversaw the printing of the largest amount of money in the shortest period of time in the history of our republic. Wow.
Right.
Then you got our famous Janet Yellen.
Oh,
The party line: inflation is transitory.
unbelievable. She is just, I call her Mrs. Magoo. Your generation won't know who that is, but there was a great comic when I was a kid called Mr. Magoo, and he was a blind guy who wandered around creating chaos.
I guess apparently they eventually did admit that they were wrong, Powell and Yellen.
Yeah. The good ship transitory has sailed. He joked about it. It's sick. I mean, it's really sick.
Yeah.
People suffered enormously from the inflation coming out of COVID, and he made a joke about it.
Wild.
Yeah, he's a bad guy.
Those of us who've studied the Austrian school, this was completely obvious that this was going to happen. I mean,
absolutely.
It was just like a no-brainer.
Yeah, the Austrians predicted it.
Wow, you have in the notes here, she received over $7 million of speaking fees from the banks and financial institutions she regulated between her time at the Fed and her appointment to Treasury. Many times she was paid over $200,000 for 1 hour speech. You said that earlier.
And Citadel paid her $800,000. Citadel accounts for 25% of the trading on Wall Street, and they were bailed out in March of 2020. So Ben Bernanke sits on Citadel's board of directors, and it's been rumored that he's getting paid like $10 or $20 million a year. I don't know if that's true, but and when this whole thing happened, when March of 2020 happened and correlations went to 1, the markets blew up. Well, he was involved in something called the risk parity trade, and it's pretty certain that his firm blew up as well. And my sense is that what happened is Bernanke was able to make the call to Powell and say, look, if you don't give this guy a swap line, i.e. free money, the whole system's going to come down. And so, I strongly suspect that he got a swap line in March of 2020.
I would not be surprised at all.
I mean, and there's some evidence of that. I've been in some Harvard meetings where his wife was president, another Harvard director was president, and it's pretty much, it's kind of a quietly known secret that he got bailed out.
Interesting. The Fed is a menace. I'm going to read this little chapter you have here before we talk about the Fed. Yeah. The bottom line here is that no set of individuals, regardless of their expertise, can accurately set the market price for money. Even if they were omniscient, they could not do it. History has shown time and time again that the Fed's approach is either too loose or too tight and is frequently behind the curve. Some have accurately described them as both arsonist and firefighter. I cannot disagree. Corruption at the Fed only adds to the problem. Recently, 2 well-known Federal Reserve Board governors from Boston and Dallas were forced to resign after failing to report personal trades of S&P futures contracts at critical junctures in Fed policy. Chairman Powell dismissed the ethical breaches as merely an appearance of conflict, right? Even more troubling, the current Atlanta Federal Reserve governor remains in office despite recently making 154 undisclosed trades during blackout periods, a clear violation of trading restrictions.
Amazing.
That is wild.
This is the Federal Reserve, right? I mean, it's unbelievable. He's still there.
Yeah, wild. So let's talk about the Federal Reserve. That's the next chapter here. It enables the creation of money out of thin air, which we know. Ron Paul pointedly observed, ending the Fed would be the single greatest step we could take to restore American prosperity and freedom and guarantee they both have a future. Wow. So in this chapter about the Federal Reserve, you talk about this idea of the third mandate, right? It's kind of this unwritten rule.
Yeah.
Do you want to unpack that a little bit?
Sure. So the Fed, when it was originally founded, was just meant to be a backstop for the banks. And in 1978, I think we spoke about this a little bit earlier, they got a dual mandate, which was full employment and stable prices, which they interpret as 2% inflation. And but there's a third mandate that is not written down, but we all know exists, and that is turn on the printer when things go wrong. And so put in simple terms, and they've actually made statements, and I've repeated some of them in the books that say, when the Fed stands ready to ensure that financial conditions remain normal and secure. And I call this the pull the emergency brake or hit the emergency alarm mandate, part of their mandate, which says that they will provide liquidity if the financial markets seize up. And we know this to be true, right? Because we've seen it multiple times, most particularly LTCM, and then 2008, and then the repo blowout, and then COVID are perfect examples, and Silicon Valley Bank.
Yeah.
And when things go wrong, when the financial system starts to malfunction, when the leverage proves to be too much, and of course it's being proven as too much because debt is growing faster than GDP. The Fed stands ready with the printer to address the issue by creating more base money. And so they've done it. I named the book The Big Print. It's funny. I should have called it The Bigger Print or The Biggest Print.
the biggest print so far.
The coming biggest print, because we've actually had two big prints. We had one in 2008, and then we had another in 2020. And of course, in the book, I lay out the case for why I believe we've got another one coming. And so, this is the third Fed mandate, which is healthy and continuous financial conditions, and they're prepared to use the printing press to make sure that those exist.
Powell says that you're wrong. He says this is not QE.
Yeah, isn't that amazing?
In no sense is this QE. These purchases of Treasury bills should not have any meaningful effect on the stance of monetary policy.
I said that recently when he it's unbelievable to me, some of the things they say, and they gaslight us. They act as though this is the only way it can be and it should be, and those of us who question it are, nut jobs or conspiracy theorists.
Yeah. If using a computer to add reserves to the banking system, mouse click money, and purchasing Treasury bills from primary dealers is not QE, then what is it? I am stunned that the financial press did not call nonsense on this lie. Yeah, I mean, I think
there's so many things they say, and you look at these guys who go to these Fed meetings, and they're like stenographers. You know what I mean? They just write it all down. I mean, Nick Timieros, from Nicky Leaks. I mean, he just, he wrote a book about how great the Fed is, So they're not really reporting.
Yeah.
They're just, they're recording and cheerleading.
I think all media has this, all corporate media has this.
Well, I was going to say, this exists in other areas
this
too.
Is nothing new.
Right?
Yeah. This is, and then that's why the trust in media and government, et cetera, is, we're in the teens right now.
It's very low.
We could go to single digits here, which is insane because, like you said, 15% of the people work for the government.
Exactly. Yeah.
So wild. We kind of talked about Silicon Valley Bank a little bit, so I don't want to harp too much on that. But I thought it was interesting how you talked about this movie, It's a Wonderful Life, and kind of depicting how that the Bailey Savings and Loan thing went through, and how the Great Depression and all this stuff. And I thought it was interesting. But what was really striking about the Silicon Valley Bank thing is just the speed in which it unfolded, because
that's the thing.
We're now in a digitally connected world. that's in
that event, that's what really jumped out at me. I have the number in the book exactly, but I believe that they lost roughly $40 billion worth of deposits in
$42 billion,
$42 billion in one day. So that's a digital bank run. I mean, in the olden days, in the 30s, when they had bank runs, the people would go and they'd queue up at the bank and they'd say, give me my money, like they did in It's a Wonderful Life. Now, in this particular case, what happened is the bank had a sale of some bonds. They were very severely marked down. Mm-hmm. Some accountant did the math and said, oh my goodness, this bank is bankrupt. He called up his employer at a venture capital firm. That guy called every other venture capital firm and said, look out, Silicon Valley Bank's in deep trouble. And within the space of a week, Silicon Valley Bank was bankrupt.
It reminds me of there's a quote later on, I think chapter in the 20s, much later in the book. It's something the one who panics first panics best.
Panics best.
I don't know who said that.
Yeah, it's a good
I remember
line.
it later on in the book.
I think that might have been from the movie Margin Call.
Yeah, it made me laugh. But it really is striking when you think about how this all happened. They wanted to blame. They tried to swing this over to our industry. They tried to blame this on crypto, Bitcoin, whatever.
Yeah,
that was like what they tried to do. And it was like, no, this is governments mandating you to have shitty government debt, and then they do the fastest hiking cycle after they got the call wrong and saying that inflation was only transitory. I mean, you literally can't make it up.
Yeah.
And then they had the law earlier that basically said, where they passed this law that said that, what was it? It was something where they can value it at full.
Oh, yeah.
We just talked about it.
SAB 157.
Yeah.
Right, where they allowed them to take debt and call it held to maturity debt.
Yeah, yeah.
And not have it reflect the right market value. And that's what actually killed Silicon Valley Bank. I mean, when rates were low, they bought all this long-dated treasury debt. And, unfortunately, the treasury rates went up a lot, and suddenly they were underwater on all that debt.
Yeah.
And that's the math that the accountant did, where he said, oh my God, you don't have any equity left because you lost money on these bonds.
I mean, this is all just like a slow-moving train wreck of like a series of unfortunate events, and at the root of it all is like the government making these decisions and doing these different things.
Well, right. Well, and it's kind of like the little kid with the dike. I mean, you can put your finger in one hole. Okay, so we're not going to mark bank assets to market. We're going to have held to maturity. Oh, that's okay. That's great. That solves the problem. But guess what? 15 years later, or whatever the time frame is. I mean, it's about 15 years later. It bubbles up in another area.
Yeah, yeah. No doubt, no doubt. Let's talk about Dodd-Frank for a second before we move on. Dodd-Frank was supposedly meant to end these government bailouts. Correct. And it's just so funny how they play these games and they change the definition of words and they just do all this funny money. I mean, I got to give them credit. I mean, like they've come up with all these little schemes. But
you do have to give them credit because they're very creative and they use language in their own favor and they gaslight us and they change the rules. And but let's just to emphasize what you brought up Dodd-Frank, so I'll mention because it's a real point of I'm angry about it. So 2008 happened. The banks got bailed out. Everyone knew that was wrong.
Yeah.
And so, Dodd and Frank, Barney Frank was my senator from Massachusetts. They got together and they passed a bill that said there will be no more bank bailouts. We're not going to have that. It's not fair. And, credit them for doing that. Silicon Valley Bank failed. And in theory, what should have happened here is the depositors should have taken a haircut. They were down about 20% on the total bank's assets. So everyone who had money on deposit at Silicon Valley Bank should have lost 20% of their money. Well, that was not going to happen. And so they used a rarely used rule in the Federal Reserve Charter that, and they realized that if they did that, there was a chance everyone was going to bank run. So bank deposits everyone knows this, are insured up to $250,000 by the SBIC. Well, so if you have $2 million in a bank and the bank fails, in theory, you should lose $1.75 million. You should get the first $250 and not the balance. And in fact, the banks, if that happens, then there'll be cascading bank failures. I mean, everyone, and in fact, when Silicon Valley was in trouble, there were corporate treasurers who had money in banks that was over 250 who were withdrawing it because there was the possibility that they wouldn't be protected. And in fact, I remember speaking to some of these corporate treasurers at the time or people who knew them, and they were saying that really the only safe place to be is JP Morgan.
Yeah.
Because we know JP Morgan won't fail because it's the Fed's bank. Yeah. And so when it became clear that there was a potential for a bank run, and Bill Ackman pointed that out and others pointed it out, they came in and they used this systematic risk to the system, clause of the Federal Reserve Act. And they basically guaranteed all the bank deposits, and they made the depositors of Silicon Valley Bank and First Republic and a couple of other banks whole. And of course, that was a blatant violation of Dodd-Frank, but they assumed that one law trumped the other.
Wow. You know what's funny is that at the same time, I was getting choke pointed at one of my banks.
Yes.
And this was all going on.
Sure.
You're an unapproved industry. And I literally spoke to them on the phone and I said, are you eventually I was able to appeal to the vice president of the credit union and get the whole thing actually resolved. Basically, I gave them their mission statement. But on the phone with the people who were in risk management or whatever, I told them, I said, are you sure you want to be getting rid of depositors who have been banking with you for years right now?
Right.
Are you sure?
Does this really make sense?
Your mission statement says that you're based 90% of your decisions based on relationships. I said, looking back at the past 5 to 10 years of business together, I've referred, I've done multiple auto loans with you personally at personal accounts, multiple business accounts.
Yeah.
I've referred family members and are you sure you want to be
is this really
chasing away?
Doing?
Yeah. Do you think this is really a financially sound business decision?
Yeah.
And I put all this in an email and I put their mission statement. I was surprised with this credit union. I was actually able to escalate all the way to the vice president, and they made the call that said, you're right. We're not going to.
Oh, is that right? That's good.
Yeah.
That's really good.
Yeah. It was kind of wild story. But it was just kind of funny at the same time. You're in an unapproved industry. I'm like, you do realize that all these banks are failing because they bought actual government debt that was supposed to be not risky.
You were in an unapproved.
That's what I said. That is pretty much what I said in a nice way.
Yeah, you guys are the guys who are in trouble, not me.
Yeah. That's literally what I said in a nice way.
Yeah.
In a very nice way. So, but I was able to get that reversed, luckily. But yeah, I also had an account at First Republic, so when all that was going down, it was interesting to see.
Silicon Valley was my bank, and now I'm with the First Citizens.
And I guess Signature was actually destroyed. They actually Signature wasn't going to fail.
Yeah,
but they actually
they made
took them out because they had that
choke point got them.
Yeah, they choke pointed them. Yeah, I think Nick Carter has done a lot of research and investigation.
Yeah, and Caitlin Long knew about that
as well. Yeah,
too.
Yeah. So it's a travesty what they did. I think it was, speaking of, it was, wasn't it one of the guys from Dodd-Frank himself who was on the board? Wasn't it? I
don't recall that. It's possible. I don't know the details.
I'm trying to remember the guy's name. Paul, look up who was on the board. I literally think it was Dodd.
Was that right?
Signature Bank. Yeah, it was one of these guys who helped write the Dodd-Frank Act, I believe.
I ask who are the directors of Signature Bank?
Who are the directors of Signature Bank? Yeah, I think that's actually interesting. But they actually wrote this legislation themselves. Oh man.
Barney Frank.
There he is, son of a bitch.
Isn't that amazing?
Isn't that fucking crazy? And he comes out and says, "Hey, we're solvent. What the fuck's going on?"
Yeah, no, actually, I remember
this.
Yeah, I remember when he said it too, and it was kind of like, and I think he kind of pulled the veil back and said, the government's going after this bank.
Yeah.
And to his credit, right?
To his credit, yeah.
Yeah.
Wow, it was wild. Then they've got the news. So, got to give credit to you wrote here too to Yellen. They said you wrote a blatant bailout and linguistic sleight of hand, a masterclass in political messaging. The bank term funding program. Here's the newest one.
Oh yeah,
we got ZERP. We've got all these different ones. This is the BTFP.
Buy the
fucking dip.
Effing paper.
Buy the fucking paper. Yeah, I love that. Yeah. Buy the fucking paper. BTFP. So this is basically it would allow banks to send their impaired assets to the Fed and receive 100 cents on the dollar or face value on bonds, which may be worth 70 cents or less.
Right.
How does this one math out?
Well, that's effectively QE.
Yeah.
Right. I mean, they're taking in an asset that's impaired, and they're sending out a brand new asset that's at full value, and so let's say the asset they took in was worth 70 cents. They gave you $1 out. They just printed 30 cents worth of money.
Yeah.
Now they claimed it wasn't QE, but again, that's just linguistics. That's their messaging.
They used a systemic risk exception,
right, to bail them out.
Exactly what Dodd-Frank had prohibited. So they just violate this is where you think about laws and constitution and power. And my friend Samuel Arms, he runs the Florida Business and Blockchain Association for many years here, and we got the anti-CBD stuff passed. But he always makes the claim that when you have power, when you have control, like history, if you look at it, is like people just grab it, even if the law says no or it says that. For the most part, it's like
That's what we're coming to see is that there's a lot of slack in the interpretation.
Exactly,
and these people, they are in control of the system.
Yeah,
so they can interpret it in ways that benefit themselves.
Mm-hmm. So. At writ large, this was a massive display of more crony capitalism.
Yeah, it sure was.
It's just kind of wild. We've got a whole section here on Janet Yellen. I love some of her quotes. I think this is where you call her Mrs. Magoo, maybe.
Yeah, I mean, she just says stuff that's just so wrong. I mean, and that's what when we were talking earlier about the Fed reporters. I just can't believe that there's not. I mean, maybe Trump, by letting other people into the press corps, we'll finally start to get some tough questions, but there's some blatantly obvious tough questions that need to be asked that there's just no one in the press asking.
So Thomas Honig, this is another guy do you know him?
Not personally. I just know of him. I've read a lot about him. Yeah.
I guess
I wish I'd met him. He's a good guy.
He's kind of like a canary in a coal mine.
Yeah.
They really I guess frown upon that, and they kind of blackballed him a little bit.
Oh, big time.
Because he was dissenting from all of the PhD educated civil servants.
Correct.
And the mighty brains who rule the FOMC.
Yeah.
Janet Yellen said, "I personally see them damaging our credibility and our reputation at a time when the institution is under enormous scrutiny and we can ill afford it."
Right. Yeah, so what he's referring to is Thomas Honig was a Fed governor when they began QE, and he was the one Fed governor who dissented. I mean, he knew what it would do. He knew it would create wealth inequality. He knew it was unfair. He knew it would lead to inflation. And he said so. And he had the courage to say so. He's a Midwesterner. He's from Iowa. He was a Vietnam vet. And here the thing that's most interesting about him. The reason I put him in the book, and it was a great book by a guy named Chris Leonard that gave me this information. The reason I put him in the book is this guy had worked for the Fed for his entire career. So this is not, Larry the crank or, Matty the Bitcoin guy, coming in and criticizing the Federal Reserve. This is a guy who'd spent his entire career at the Federal Reserve, and he had the courage to say, folks, what we're doing here isn't right and it doesn't work. And I thought that was incredibly brave on his part.
But the Fed is politically neutral. Don't you know that?
That's what they say.
I mean, they just didn't like his kind of neutral.
Well, that's what they say. Yeah, exactly.
They didn't. His opinions weren't.
They don't count. Well, and he wasn't. Yeah, I don't think. No, actually, I think he might have a PhD in economics. I can't remember what his background was, but yeah, he. It's nice to see that in spite of all the corruption in our government, that occasionally, like a Ron Paul, that occasionally somebody's in there who understands what's going on and says, no, this isn't right.
Yeah.
But he was very much ostracized and blackballed as a result of that behavior.
Virtually all of the predictions Thomas Hoenig made about quantitative easing and 0% interest rates would come true over the next decade. So fascinating. And Leonard, I guess this guy wrote in his book, this is a funny one, to the everlasting joy of every conspiracy theorist in America, a group of ultra-powerful bankers got together and held a secret meeting in 1910 in which they created the blueprint for an American central bank at a luxury resort called Jekyll Island. Classic.
Yeah, and then you're missing the line that I put right after that. I said, now you can see why they were right, and welcome to the club,
Welcome
Chris.
to the club, Chris. Oh, man, too funny. This was, I think, an inflection point as well. The 60 Minutes interview. This is a classic one, where Pelly asked him about the inflation risks inherent in printing so much money. And Bernanke said something which tainted the understanding of quantitative easing for years. One myth that's out there is that what we're doing is printing money. We're not printing money, he said. The amount of money in circulation is not changing. The money supply is not changing in any significant way.
And even Chris Leonard, who is a renowned New York Times reporter, very mainstream, very establishment, not Larry the conspiracy guy, even he said that this was an untrue statement.
Mm-hmm. Yeah. Here's a Ron Paul quote. In the United States, the creation of the Fed fundamentally altered the balance of power in our democratic system. Votes, campaign promises, polls, public opinion, laws, restrictions on the state. All of these forces took a backseat to the goals of the government to expand. Imagine an irresponsible teenager with an unlimited line of credit. The parents, teachers, pastors, and authorities in his life are ultimately powerless to change his habits. Now imagine that teenager armed to the teeth and also immune even from the rule of law. This is what you have with a government backed by a central bank. Well, that gives me goosebumps reading that.
Isn't that an amazing quote?
It is an amazing quote.
Because it really is true. I mean, it's almost like the Fed runs this country.
Yeah, and then Daniel DiMartino Booth uses the words hubris and myopia to describe them.
She worked at the Fed, and I know her, and I really admire her. She worked there for, I think, 9 or 10 years, and she was just appalled. She's a business person. She was a Wall Street person, so she had a lot of experience with the financial markets. And her reaction was, she was appalled by how tone deaf and myopic they are in terms of watching, thinking through what the policies do.
I love the name of her book, Fed Up.
Yeah, right.
Booth describes an inbred culture at the Fed whose 1,000 PhD economists look dimly on real-world practitioners. These academics, entrenched in their theoretical models and specialized jargon, mock the real-world input from professionals with business backgrounds like Booth and Fisher. Yep. Academic hubris and a lack of introspection comes at a cost.
Absolutely.
This is exactly what we're seeing in academia today, in Harvard and a lot of these elitist institutions where, they're just so disconnected from the real world.
They think they know better.
Yeah, they've got their models, right?
Yep.
But they
are the elite class, and they are the educated people, and we should listen to them. And all of us rubes don't know what we're doing. We're all just deplorables, as Hillary would say.
They've got their elitist models, and so one thing. I have a degree in a statistics-based degree, and one thing we learn is that and this is a famous thing: is that all models are wrong. Some are useful, right? That's a famous.
I like that. That's a good line.
Statistical quote.
Yeah.
which is true, like because we do it too, and we model out for our,
Sure.
our mining deployments.
We're
We
all
show
just doing the
people.
best we can.
And I told John, you got to put this on here, John. These are, we can't control the price of Bitcoin. We can't control the difficulty adjustments of the network.
Right.
Like all these factors.
You're making assumptions.
Making assumptions, exactly. So like, and highlighted in big yellow on top, it just says all models are wrong, some are useful. So that's what we do now. This is my favorite Jenny Yellen quote. After all this chaos and crazy things, after the great financial crisis is indicated of an utter lack of awareness, she is like a modern day Miss Magoo. And then she goes, I will be the first to say that it is always difficult to get monetary policy just right, but the Fed's analytical prowess is top notch and our forecasting record is second to none.
Put the date of when she said that.
That was the 2009, June 20th, 2009.
So they completely missed the dot-com bubble. They completely missed the housing bubble. And here she is in 2009 talking about how great they are at forecasting the economy.
These people, it's
right?
It's just unbelievable. And then she goes, inflation's transitory. It's like these people, if they were in private market or any kind of private,
be fired.
They'd be fucking done.
They'd be fired.
But there's no incentive. There's no feedback loop that says,
talking to themselves.
Yeah. This is a funny one too from the ECB and
we got serious. You got to lie.
Jean-Claude Juncker, Prime Minister of his name is literally Juncker. He's a Junker, Prime Minister of Luxembourg and President of the European Commission, who is discussing how to handle the 2011 European sovereign debt crisis. Specifically, Greece said, "When it becomes serious, you have to lie." I mean, this is how these people think, and this is not just economic policy.
I can't believe he said that publicly.
This is COVID policy. This is everything they did. They knew what they were. They knew they were lying to people. I mean, this is just how these elitists think. How these bureaucrats think. They think that you are an infant child.
We're all just little pieces on a game board to be moved around.
Exactly.
And if you have to lie to us for the greater good, then it's justified because it's the great in their mind.
Yeah,
it's the greater good, and that's an enormous evil.
Yeah,
we all know.
I agree with you completely. I think it's rules for thee, but not for me. It's like
it's just
we witnessed
the ends can never justify. The ends can never justify the means because everybody's got a different view of what the end should be.
Exactly. And I think that's what's so wrong with society today, right?
Well, certainly with a lot of these government structures.
Yeah, no doubt. And then at the end of the day, half the fucking time, they're wrong. They're totally wrong. They think they're God and they can see everything. It's like,
that's the thing. I mean, even if they were right, it's not justified. But they're not even close.
Even close to being right half the time. Exactly. Right. Which is why this whole thing is so ridiculous. This idea that the Fed is their political independence and they claim to be nonpartisan and all this nonsense. But if you actually look at the numbers and stats, it's like they're immensely partisan. Right. It's like it's not even. It's so ridiculous. That's why I'm so glad that what Trump's doing, he's defunding a lot of these organizations. It's like, when you give 99% of your money to one political party and then you do, it's like, you're robbing Peter to pay Paul. And it's just we're not supporting
it's
incestuous. I mean, it's like, when the government is giving millions of dollars to PBS and NPR and all these things, and then they just continually they're super political, right? It's like,
and they're pushing lies and they're gaslighting us.
It's just got to stop. I mean, it has to stop. It's disgusting. We talked about this earlier as well, that Ron Paul and Bernie Sanders both have identified the problem. Yeah. But one has obviously a much better solution.
Yeah, Sanders has the wrong solution.
Yeah, exactly.
But he gets it. I mean, I respect him for getting it. He's correct.
Yeah. This is I love this analogy. Printing is the hammer. Every problem looks like a nail.
That's the only tool they got.
Yeah.
It's the biggest tool, I should say. It's not the only tool.
The two extraordinary privileges, right? The ability to backstop any failing institution with a bailout and the power to create money out of thin air. Of these two, money printing has become their go-to solution for every crisis, their hammer for every nail. The 1987 market crash, print. The 1998 long-term capital management collapse, print. The 2000 dot-com bust and 2008 financial crisis, print even more. We've got the repo market seizure, the COVID-19 pandemic, fire up the digital printing press. Wild.
And that's why for those who say, well, they're going to stop and it won't happen again. And all, I mean, it's just, no, we've seen this pattern and at some point in time, everybody understands that to be true. And that's an important point to make, Matty, because when everyone knows that they can't stop printing, confidence in the currency will be lost, and what we call Gresham's law will kick in, and people will abandon the currency. I mean, that's how you get the kind of things that hyperinflation really is all about.
Well, Larry, when in the words of Jean-Claude Juncker, when it becomes serious, you have to lie.
You got to lie.
Oh man, I want to point out one final thing before we close out this episode. This chart of the federal funds rate, annotated with the crises over time, is a really cool one to look at. It kind of reminds me of Ray Dalio's book.
Yes, anti-crisis. He's done some great work.
If you look at his long-term business cycle theory, that's when I look at that. I kind of, he kind of talks about this when you have to lower the interest rate and lower the interest rate and lower the interest rate, and that's what that chart reminds me of. So it seems no matter what, the Fed always comes to the same solution, right?
Yeah.
They always turn to the printer, and that really perfectly encapsulates the title of your book, The Big Print, because we know that no matter what comes ahead, the print is coming.
It's got to come.
I think that's a good place to leave off.
I agree.